Monaco 64, home of alternative economics and contrarian views. So it's Friday, January 9th, 2026, not 25. I've made that mistake, but I was able to correct it, Clive. And it's great to have you back, Clive. You've been away for a while. You were in Crans-Montana. Was it a couple of weeks?
I've been away for about 3 weeks. I mean, we were off and on, but broadly speaking, 3 weeks.
Yeah.
And we were there at the time of the Crans-Montana disaster.
Yeah.
We Our hotel was looking away from where the accident happened, but my wife was asleep. I could hear the screams, but I thought it was kids just throwing fireworks around at the time.
Yeah, I mean, Crans-Montana, I know it well because I used to go there when I lived in Switzerland in the summer to play golf. They had some really good amateur tournaments there, and they played the European Tour event there. It's a great course, good views. But anyway, Clive, one thing I wanted to tell the viewers, Clive is, I think, almost up to 90,000 subscribers. So let's get Clive a silver plaque like that one. And if you haven't subscribed to his channel, Clive Thompson, do so. I mean, it took me a lot longer than you, Clive, to get 100,000, but I guess the next one is a gold plaque, but that's at a million subscribers. So it's a 10-to-1 ratio there. YouTube has, isn't it? Gold silver ratio.
Yes. So everybody who hasn't subscribed to you, Mario, now's the time to hit the subscribe button so you can show them all your gold plaque in due course.
For me as well, those of you who watch me and haven't subscribed, make sure you do. But more seriously, Clive, I was looking at and I'm going to bring it up, a chart of silver the other day. There we go. This line here. And I posted on X yesterday, and I'll bring the X post up in a minute. But I said that, silver was climbing a wall of worry here. This is the daily chart. And I had this trend line. And during the day yesterday, it got a bit worrying. Not really worrying, but we dropped below that line. But it came right back up. And today, Clive, as we speak here, as you can see by the screen, silver is now up 63 cents. So I mean, we could be at 80 very, very quickly, of course. Gold is also back up. I think we got almost back to 4,400 in gold. And on an annual basis, we're already up, I think, almost 10% in silver and up about 2.5%, 3% in gold. So yeah, I think yes, silver has made a mini comeback, and I think silver could be ready to explode higher in terms of price. What's your view?
Well, yeah, it's already higher this morning in Shanghai. It's trading this morning in Shanghai at the equivalent of $82 an ounce, and we're at sort of 77.60. So it's about $4.50 higher in Shanghai. Obviously, we've got this Bloomberg recalculation going on, the Bloomberg Commodity Index recalculation, which should bring out net sellers in silver over the coming week. But that would be fairly muted. So I think the bigger problem here is what's happening with manufacturers who, when I say manufacturers, I mean manufacturers of vehicles, manufacturers of electronics, manufacturers of solar panels. They need to have a supply of silver, which they can get, because otherwise the whole production line comes to a halt. So if you're a car manufacturer, you're putting in something between zero point 0.6 an ounce of silver and 1.5 ounces of silver into a car. If the price of silver goes from, let's say, $20 to, let's say, let's say $100, for example, that's an extra $80 on the cost of your $50,000 car. So it's neither here nor there, but they can't stop the entire production line because they can't lay their hands on silver. So I think what's going on here is there's been a little bit of an acceleration by various manufacturers saying, hang on a minute, it looks like silver's running out above ground. We better hurry and make sure that we are the first in line to get ourselves some extra supply. So instead of just-in-time supply chain, we want to have a 2 week supply or a 1 month supply, and I think some of them are building up their supplies, their stocks, to make sure they won't run out because they can't stop the supply, they can't stop the production line for the sake of 50 cents of silver.
Yeah, and I've been hearing also, I think it was a Silver Academy on Substack, that silver was trading above $130 in India. I mean, I haven't really got any more information about that, but here's the post I did yesterday about the silver chart. And yeah, so I said daily silver chart climbing over. The commercials continue to pile in the paper shorts, but physical demand will overwhelm them. And I think it's just what you were talking about, Clive. The people, industry and I also think investors and central banks and sovereign wealth funds, paper won't do for them anymore. They want the physical. So yeah, we saw after I posted that Sod's Law, we retested that line, almost broke it, but now we're back above it. This is not live, of course, this chart. And yeah, what else?
Well, I'll tell you a few little bits of anecdotal evidence, information. Um, when I was last in Tron, Montana 2 years ago, I managed to buy myself a few gold coins from a shop which has gold and silver sometimes. And I was going to go, I would try to go back in the shop twice over the Christmas period. And each time I couldn't get in the door, the guy said, "Look, come back later." And I came back later, and then it was busy. And I planned to go back before we left Crom, Montana, but we couldn't go back at the very last minute because the entire road was blocked off due to the disaster. So I couldn't go back in the shop to see if he'd got anything. But on Monday, because I'm in a hurry to get some, I went down to Degussa in Geneva, which is a very large gold dealer, gold silver dealer. And I went in the door and was told by the doorman, "I'm very sorry that the demand is so high that you have to make an appointment now." Now, this is the first time it's ever happened to me. I mean, going to Degussa every few months, and it's usually empty or there's two or three people waiting. But this was the first time he said, "Look, we can't. We've got so many people wanting to do business with us. You have to take an appointment." I said, "Well, when's the nearest appointment I can have?" That was on Monday. He said the earliest you could get an appointment is on Thursday. That's yesterday. So I would have had to wait 4 days to get in the door to buy any gold and silver. And the purpose of me going there, I basically wanted to buy any of the new 2026 coins that they had in stock. Quite often the nicest ones they sell out very quickly, and there aren't any more. For example, the Spanish bring out a gold coin every year with an animal on it. I like to get those, and of course the British have got the beasts of England and so forth. So I constantly pop in to try and get these coins, and especially the new ones, the new issue, which would be the 2026 issues. But unfortunately, they said demand is incredibly high. They never experienced. I asked him. I said, "Is this people buying or selling?" He said, "It's overwhelmingly buyers."
Yeah, yeah, and Degussa is a German company. It stands for Deutsche Gold und Silber, Degussa. And actually, I used to have a client when I worked in the city. He worked for a big American bank in Frankfurt, and we kept in touch. And he eventually went to work for Degussa, and he actually helped open the store in Geneva. He doesn't work for them anymore. So that's interesting. And I was just looking here, Clive, at SD Bullion. They're a big bullion dealer in the U.S. And this is how much the 1 ounce silver eagle. I mean, this is going for $89.27. And right now, silver is trading what at $77.
That's a $12 premium.
I mean, it's like 15% or more. Like.
And I think what's going on with the premiums here, the volatility of silver has increased a lot. We're having sometimes moves of up to 10% in a single day. So if I was a dealer, I would be saying, I don't know if the next person to come in the door is going to be buying or selling, but I can't afford that he comes in and does a transaction with me and then the price moves against me by 10% within the next hour or 2 hours. I've
Yeah,
got to increase my premium to make sure I
uh,
continually make a profit.
I partly agree with that, but I also see that like there's some dealers in the UK, they can't get any silver, even though some have gotten some. I think there is a bit of that, a shortage of silver, and and I think the wholesale market might be like holding off physical silver. And there's an article here by David Jensen, who comes on the channel regularly, and this is from yesterday. He says, suddenly a COMEX silver delivery rush on limited vault inventory. So he says, I'll just read a little bit here, Clive. The thesis that this Substack has been building is that 2025 the delivery dysfunction and even days of trading dysfunction seen last year in the City of London's physical silver market, the world's largest, has revealed that London holds almost no physical silver relative to the billions of ounces of cash spot market contract claims for immediate silver bar ownership and delivery that have been sold and stand in the London silver market. So, and it says, as a consequence of this, of the diffusion of this knowledge, it would be expected to see startled owners selling those claims to London bullion bank operators, taking their USD and securing rapid physical delivery elsewhere. Due to the scale of the London problem, securing of silver in other markets would be expected to be akin to a quietly but quickly building rush. And he says on January 7th, 2026, data from COMEX, CME COMEX market shows how this delivery rush for silver may be increasing, keeping in mind that in addition to New York, we are seeing price premium for silver delivery in other global markets, ex London, indicating accelerating silver buying elsewhere. So here we go, January 7th. So holders of 1,624 January silver, which is not the front month. So here, so he says he notes here on January 7th, holders of 1,624 January 2026 silver contracts, so 5,000 ounces per contract. They received delivery of 8.1 million ounces of silver delivery warrants for COMEX warehouses, with JP Morgan issuing, delivering 99% of the total to numerous stoppers, receivers of the metal. So the interesting thing is, Clive, and you know that, is the January contract is it's not really the most traded one. We never really see this happening. And he notes as well, which is interesting, that the open interest as well went up. So it says here, what is interesting is that despite this contract delivery yesterday, the open interest for January increased by 1,431, ending the day with an open interest of 2,155. What that means is that someone went in there and bought probably another 1,431, or several people. And why would they buy a contract that's not trading like really liquidly? Well, because they want the physical. And I think this is really significant, Clive. And
Yeah, so this could be a manufacturer of end products which uses silver, and they want to be absolutely sure they can secure the supply.
yeah, but but Comex has never really been a physical market like it has been. I remember you looked at the deliveries last year. They were much larger than the previous year, and I think it's continuing. And you can see here they're doing the same thing for February. The open interest in February is 3,400. And look at it. I dread to see what will happen when we get to March, Clive.
Yes, a lot of open interest, which might, 104,000 contracts of 5,000 ounces each.
Yeah.
I can't do the maths on that, but it's a lot of ounces.
But of
Uh,
course, the March, sorry to interrupt, March is actually the mostly traded contract. So that open interest will drop, but it will be interesting to see what it is in March itself, which is when you can start taking delivery, right?
Yeah, and obviously probably going to be mathematically impossible for all of that silver to be delivered. So most of it will be rolled over, but it will be interesting to see if the delivery amounts are higher than usual. They all every month last year, the deliveries taken in COMEX were higher than they had been in the previous year, and significantly so, mostly by more than 100% higher.
Yeah, yeah. Um, Clive, last yesterday afternoon, late afternoon, or I don't remember exactly. This news came out. Glencore and Rio Tinto resumed talks on 260 billion mining mega deal. Discussions over a tie-up to create world's largest mining group come as race to secure copper reshapes the sector. And I think they do a lot of coal and iron ore, these two companies. But I think, and I want to know what you think for as well. But I think this is not. Yeah, it's about copper and coal and iron ore mostly, but I think this is going to spill over even into the precious metals because, as you say, people need the supply. The silver shortage as well and deficit has been accelerating, right? So yeah, how do you see this piece of news?
Well, I think it's related to the commodities sector in general, which brought apart from the precious metals recently has broadly speaking been in the doldrums. And I think the expectation is that commodity prices are on the cusp of moving up to reflect the general level of inflation we've had over the last decades. So, the when you combine two very large companies, you get huge economies of scale in terms of you don't need two personnel departments, you don't need two accounting departments, you don't need two management teams, and so forth. So I think they're gearing up to benefit their shareholders effectively from the higher commodity prices to come and from the efficiencies that they're going to need as demand increases.
Yeah, yeah, that's right. Today, Clive, we have non-farm payroll, and I think also at 3 o'clock London or 4 o'clock your time or 10 a.m. Eastern time. Uh, I think it's the Supreme Court. They're gonna rule on the legality of tariffs. That could be really important, right? I don't know if you saw that, but
It
I
would be
think
important.
yeah, and you've probably seen this news that from Trump. I'll bring it up. This here, Donald Trump calls for 50% increase in U.S. defense spending by 2027. I mean, it's a huge increase. Maybe he's trying to make it so that defense spending is still bigger than interest payments for treasuries, because a lot of people have been noting, oh, interest payments for treasuries are now more than defense. Or maybe he's planning to invade some other countries. So, more seriously, what do you think? He says he'll pay for this with tariffs, but I don't think it's going to be as easy. What do you think? What's the CBO saying? You usually follow
Well,
them, don't you?
yeah, yeah. So I haven't followed what they've said, but at the end of the day, I think this is sending a signal to the world, and we're seeing it mentioned in Europe as well, that defence spending generally is set to increase at a faster pace. Geopolitical situations are worse than they have been for a long time, and many countries are now saying we do need to focus on spending, and that of course will increase the demand for commodities in general, but it also increases the level of government debt because if you think about it, spending on defence isn't really productive for the economy. It doesn't help the economy at all. I mean, it helps the people who are working in the army and the navy and so forth and making weapons. But at the end of the day, increasing spending isn't making the average consumer giving him more food or more things to own. So what this is going to do is increase the level of government debt and bringing us closer to the end game where it spirals out of control across the world.
I agree. And you know what this reminds me of? It reminds me of the 1960s. And guess who was president then and instituted the policy of guns and butter? It was Lyndon Johnson, who was a Democrat. Yeah, he started the Great Society experiment, a lot of government spending to try to help out the poor and also like minorities. He increased, he basically pushed the war in Vietnam and increased the military spending. And it was one of the reasons, Clive, why the Bretton Woods system collapsed because the US went on a spending spree. Uh, and I'm sure they said at the time, well, this is going to help us win the war. This is going to make the minorities and poor better off, and it's all going to trickle up or trickle down. And some people might be thinking I'm crazy to compare Donald Trump to Lyndon Johnson, but he's doing the same thing. He's talking about giving people $2,000 checks. Well, that's welfare. He's talking about increasing spending for war. That's guns and guns and butter. He's doing the same thing, and it did. I think we're on the same road to what happened in the late '60s, early '70s, and we all know, Clive, that that road was paved with a lot higher gold and silver prices.
And we've got a lot of worrying noises going on. Venezuela, Cuba, Greenland. We don't know. Nobody knows how all this is going to play out.
Geneva.
But yeah, I hope not. But of course, it's it's getting to be very worrying. Of course, you've got the Taiwan situation as well. It's worrying.
Yeah. So I think this is going to be also bearish for the bond markets. And talking about the bond markets, I'm sure you've seen how JGBs are continuing to rise, even though they,
Yeah.
I mean, I think the 10-year there's around 210, and I think that's going to continue. And in the US, right now as I speak, the 10 years at 419. It seems to be a level they're defending, 420, and then the 30 years at 485. I mean, it's been consolidated for the last few years, but I think that would be pretty serious if we break higher, especially if we have a weak non-farm payroll today, and bonds don't rally. That would be quite negative, don't you think, for the longer end? Because normally in the past, if you had weak jobs data, treasuries would always rally and yields would always drop. But now they don't seem to do that.
Yeah, but I think the thing to keep your eye on is the 30-year and the 10-year in the USA. And if the yields start to rise, that gives us an indication that we're getting closer to the point at which the Federal Reserve feels the urge to step in and buy those, printing money in exchange. Because clearly even at the present rates, the level of debt is unsustainable with the interest cost. So the aim of every government would be, and we see this being said by Mr. Trump, they need to get interest rates down. But the trouble is they can only control the short end through the central bank. The central bank's lowering the short end. But at the long end, the market itself is deciding what the yield should be on the longer bonds. And governments do borrow long term as well as short term. So the only way we can get the long term yields down to an acceptable level for as far as the government's concerned is if the Federal Reserve agrees to play ball with the government by buying into those long-term treasuries, thus capping the rise in yields, or saving the government from having to pay higher interest rates when it borrows money.
Yeah. Oh, and I think last week I noted that the Fed had done over 100 billion in QE since the end of December. But now the latest numbers came out yesterday, and they've actually sold off some of their QE. So now they're back to, if you do 535 plus 40, you get around 573. So they actually did the 40 billion they said they were going to do. I'm not sure why they did so much here, towards the end of the year. We saw, yeah, maybe there was a problem in the banking sector and they had to help out, but now it's kind of calmed down. But we need to keep an eye. This is the Fed's balance sheet and how much assets they have. They're not gonna. They said, Clive, after November they're not gonna do QT anymore. So I expect this to keep going up. Is that what you expect as well?
I think it's inevitable. They have no choice but to play ball with the government, in my opinion. And that basically means if we look at the 30-year yield, it's now at what, 485, I think, in
Yeah.
the USA. And a couple of years ago, it was at around 415, 425. So despite the short-term interest rates coming down, the long-term yields are going up. And there comes a point, and I don't know if it's 5%, but if it's 5%, we're nearly there, where something has to happen. And the obvious thing to happen would be for the Federal Reserve to do this QE, not QT, which is shrinking the balance sheet. QE is expanding the balance sheet by basically buying more of these bonds to keep the yields in check. And of course, as I said, when they buy bonds, the only place you can lay your hands on money to do it is to print it.
Yeah, yeah, that's right. And what else is going on? Yeah, in terms of the stock market, of course, they were up last year, but in terms of gold and silver, everything was down. Do you think we are near some kind of event in the stock market, or do you continue to think that we could see continued melt up in the markets? If the markets expect the Fed always to come and step in, it's almost like having a put on the stock market, isn't it?
Well, history shows that we're always, at every moment in history, close to a market meltdown. Most of those market meltdowns don't actually happen, but they're widely predicted. So the way I play the game is not to sort of say it's going to happen at this precise moment or this time. You know it's going to happen at some time, but that might be tomorrow or it might be 5 years from now. So the way to play the game, I think, is to be prepared for all eventualities. And that means that anybody who has a portfolio of equities needs to balance it out with other assets, such as gold and silver. And of course, there are many other things you can put into a portfolio as well, apart from equities. But, those who are in the traditional 60 equities and 40 bonds have got it wrong. They need to add gold to that balance. And I would say, I would go with, if it's only gold, I would take 20 away from the bond section and put it into the equity section. So you become 60, 20, 20. So you
Like
now
Morgan
have
Stanley, right?
exactly. So you have 60 in equities, which probably mathematically is the right way to play the game because the odds are on your side that it goes up. But the odds are definitely against you on the bond side. So you need to be moving that 20, out of the 40% in bonds, you need to be moving half of that into gold, which will do the opposite of what the bonds do.
Yeah, I would. Yeah, it's interesting because when you started talking about the stock market, I was thinking I'm going to ask Clive what his allocation is. So you've answered that already.
It's 50% equities, Mario.
Or is it 50 and 50% gold or?
Oh, no, no. I would say, I'm not sure what the gold is, but I'm going to say it's in the range of 20 to 25.
All right.
Probably.
I mean, I would say I wouldn't keep much in bonds. Maybe 10% in short-term bills, but nothing more than a year. And yeah, I would be more 50% gold and maybe I would be the opposite of you. But
Well,
you
Mario,
know,
that's not wrong.
that's why there's a market, right?
50% exposure to gold is not wrong. It all depends on your personal situation
Of course.
and how old you are and all that sort of things.
Yeah, no, I agree.
The older you get, the more diversified one needs to be. And I've got a couple of years on you, so I'm
Yeah,
a little bit
yeah,
more diversified. But it doesn't mean to say and I'm not thinking here what's the best, most attractive asset? I must have all my money in that. I'm
yeah.
thinking, sure, gold is a very attractive asset, as is silver and other precious metals. But I'm not thinking, right, because it's the most attractive, I have all my money in that area. I'm thinking, how can I prepare for the eventualities that we don't know what the world holds tomorrow? So I should have some in that asset, but I should have some in the assets, in other assets, which might do well as well.
No, I agree. So here I've got S&P index to gold ratio, and it's been like topping, I would say, and I think this 145 level here, that's really important. And in 2011, we got to 0.59, so I guess you only needed 0.59 of a troy ounce for one S&P. And let's put it on a monthly basis, so we'll go back a bit further. Yeah, I think there's a lot of room for gold to outperform the stock market. In 1980, you only needed an eighth of an ounce, basically. So yeah, pretty interesting.
I agree with you. I think everything for me points to the gold price continuing to outperform stocks uh, over a reasonable period of time. We don't know, it's hard to put a date on it or a time, but I think if I was having a 1 year bet, I'd say gold will be the better bet.
Yeah, yeah.
Not That's not investment advice, it's a personal
No,
opinion,
yeah, no, I
but
agree.
the underlying story about gold and equities kind of points in that direction. Equities are at a higher valuation there than their historical norm in terms of price earnings ratios and multiples and growth.
Yeah,
So they're kind of high. And gold has an ever increasing number of factors coming in, like geopolitical uncertainty, higher inflation, the bond crisis that we're going to go into. All of these things are pointing in the direction that there will be a generalized move into gold, particularly from portfolio managers over the next years to rejig their portfolios so they start to include gold. And that, to my mind, means that the prospect, they're not going to, I don't think people are going to be saying, I need more equities in 2026, but I think they will be saying, we need more gold in 2026. And so for me, that kind of points in the direction of gold being the better performer.
yeah, and I think you can look at silver as well and the ratios. It's the same thing for silver. But one amazing thing, Clive, is that maybe they're starting to wake up a little more to gold and silver. But I think the vast majority of professional and even just regular investors, they've got no clue what's going on in terms of these ratios, and I think they're going to lose out quite a bit, and hopefully you guys won't lose out. I'm not saying you should do it, but hopefully you do your homework and come to the same conclusion that Clive and I have come to. Clive, any final words as we go into the weekend? Are you worried there might be another event like there was last weekend in Caracas?
No chance, Mario. Everything's going to be quite normal. We can't expect any surprises from Mr. Trump for the rest of the year, I don't think. I think everything's going to be quite smooth and plain sailing. What do you think?
Yeah, I think you're being sarcastic.
Yeah. No, what I would like to say, Mario, is I did a little video for children, or rather, it's for adults really, but hundreds of people have written to me to say they're showing it to their children. It's about Noddy and Big Ears. And the gist of the story is that Noddy goes down to the bank to get his money, and the bank won't let him have it. So on
Well,
my
it's not
channel,
not his money though, isn't it? It's
yeah,
an
so
unsecured loan.
unfortunately, the bank, Noddy's been saving his money in the bank and putting it in the bank. And unfortunately for him, the bank has been lending it to the goblins who, who when they come to get the money back from the goblins, they can't repay it. So Noddy can't get his money out of the bank. That's the gist of the story. If you look at my channel, Clive Thompson, you'll find it,
Oh,
and I hope people will enjoy it, and I hope you can show it to any. So this is for anybody who's got kids. Now I know nobody can afford kids these days, but apparently there are a few people who are having kids still.
yeah,
So if you have kids, this is for you to sit with them, watch the show, and explain to them how the banking system works and why you're not going to get your money back.
great. Thank you, Clive, and have a great weekend. And for the viewers as well, have a nice weekend.
Thank you very much, everybody. Bye bye.